Okay, so in this video we are going to do pricing decision question. So this is from the Kaplan kit of F5. So now you can if in case of any doubt you can message me in the Telegram or in Instagram with the same name of the YouTube channel, so where you can clear your doubt. Okay, so do follow me there as well. Okay, so question first, to which of the following statement is true of pricing? Okay, so let's read out the option. So discrimination is always illegal, so everyone should pay the same amount. What the question is telling, discrimination. So here be careful with the words always. Okay, so discrimination is not always illegal. Sometimes it is illegal, but in some cases it may be legal. So this statement is false. And second statement is, early adopter get a discount for being first in the market. So all early adopters are those individuals that use the new product before the majority of the people. Okay, so they will pay any price to own the product first and maintain their status, right? So it is I mean, pricing should not be like they will get a discount. It's nothing such like things. Okay, so this is also wrong. And third, pricing against a similar competitor is important in the internet age. Obviously we all are going through the internet using the Facebook and knowing about the product is price. So it's very means like it is very important to price our product against a similar competitors, so which is very important. So C1 is C option is correct. Last, price to make the most sales. In that way you will always get the most profit. Here again the word always has been used, but which will not be the case. There may be sometimes you might be in the loss. Okay, it's not always in the profit. So this is incorrect. Next, 110. Which of the following statement regarding market penetration as a pricing strategy is are correct? So market penetration is all about charging a lower price. Okay, so what the first option is, it is useful if the significant economies of scale can be achieved. It is useful if the demand for the product is highly elastic. So if you will open the Kaplan book and go through this topic penetration, yeah, there you can see that there are few circumstances told that where the penetration strategy will be useful. Okay, so first one is when company or firm try to increase their market share, they will adopt a market penetration strategy. Okay, and the second is that to discourage the new entrant from entering the market, and third, the significant economies of scale to be achieved, and last is demand is highly elastic, so would respond well to the low price. So these are the four circumstances described in the book where this penetration strategy will be useful, and out of which two has been given as an option in the question. So both are correct. So you might be wondering how the market penetration strategy will be help us to it is basically useful if significant economies of scales can be achieved. See what happened in market penetration, we charge a lower prices in order to gain a market shares, where what happened the volume of output will more volume of output will be produced. Okay, so cost will be reduced throughout those large number of volume. And if it is useful if the demand for the product is highly elastic, means if there will be little changes in the price, the demand will be correspondingly impacted. So both are correct. 111. Which of the following condition would need to be true for a price skimming strategy to be effective? So price skimming is basically charging a high price when the product is first to launch in order to maximize the short term profitability, right? Hmm. So, which of the following condition will be true? So, again in the book, it has been given some of the condition where market skimming strategy will be useful. So, I must say you guys to read out the book. So, I will explain. The first is where your product is new and have it and different from others, and where there is little competitions. So you can use the market skimming strategy. The second is when the product have a short life cycle. So here again you can use the market skimming strategy. Third, when the demand for the product is inelastic, in that case, so you can use, and firm with the liquidity problem may also use this strategy in order to generate a high cash flow early on. Okay, so these are the strategy, I mean circumstances where you can apply the price skimming strategy. So let's read out the option. An existing product where owner have decided to increase the price to move the product up market. So basically, skimming is about the new product, not about the existing product. So this is not true. With the product has a long life cycle, so it will be in this scenario penetration will be useful, not the skimming. So when product has a short life cycle, so this is true. Product I mean for the price skimming strategy, product life cycle should be short, where the only modest development cost has been incurred. No, when high development cost has been incurred, so what the owner will try to recover those costs as soon as possible, because product life cycle is short and you have incurred a highest amount of development cost, so you will charge a high price on the product in order to get your development cost recovered soon. Okay, so this is also incorrect. 112. Which two of the following circumstances favor a penetration pricing strategy? Again, the circumstances in which the penetration pricing strategy will be useful. Let's read out the option. Demand is relatively inelastic. Skimming will be useful, not the penetrations. There is a significant economies of scales. Obviously, the firm wishes to discourage new entrant to the market. This is also true, and the product life cycle is particularly short. No short, it will be long in case of penetration. Okay. So about third point, इसको मैं explain कर देती हूँ how it will be. I mean this situation will be this strategy will be applicable in these circumstances. See, if you charge a low price, so it will like any of the कोई भी अगर आना चाहेगा, so वो उसके लिए बेंचमार्क हो जाएगा, और उस प्राइस से कम में कोई प्रोडक्ट लेके आ रहा है, इन दैट केस फाइन, बट वो उससे ज़्यादा में ला ही नहीं सकता है, बिकॉज उससे कम में तो बेच ही रहा है ना कोई ऑलरेडी, सो इट विल discourage new entrant to the market. So 113, which of the following condition must be true for a price discrimination strategy to be effective? Price discrimination. Okay, so in price discrimination what we do, so two price are charged in the two market for different customer, right? The different price, I mean different price is charged in the different market for different customers. So buying power of customer must be similar in the both market segment. This is not true, because if the buying power will be similar, they can obviously so black market will be created, so customer will buy from the one market and sold at higher price at the other market, right? So good must not be able to move freely between the markets again. Obviously, if this will be the case, then again there will be chances of creating a black market where the customer will buy the product at lower price in the one market and sold it out into the other customer at a higher price. So the demand curves in each market must be same. No, it won't be the case as the company charging lower price in the one market and higher price in the other market. So obviously there are going to be different demand curves in the both market. Not it will be same. Okay, so 114. What is the maximum total profit for product X? Maximum total profit the question is asking. Demand for the product S is 50,000 unit at a current price of 1,000. Market research has determined that there is linear relationship between price and demand that can be calculated using the following function. Oh, so we have given the demand equation already calculated. We don't need to get it done. So variable cost per unit of product is 200 and fixed cost at 20 million. So I will do it this question here. So question number is 114. So we do have given the demand curve, demand equation 1500 minus, so 0.01 Q. So so now to maximize the profit, MR should be equal to MC. So MR is marginal revenue and MC is the marginal cost. And what's the equation of MR? MR equal to your A minus 2BQ. Okay, and we know what A is because already demand equation has been given in the question. So 1500 is the A, and we know the B is 0.01, so multiplying it with 2 we will get 0.02 Q. Okay, and so we also have the given in the question MC. MC is basically the variable cost. Okay, so MC equal to, it's given the question 200. So now equate the both two last two equation. 200 equal to 1500 minus 0.02 Q. So 0.02 Q equal to 1500 minus 200 Q equal to 1300 divided by 0.02. So 65,000 is the quantity where you can maximize the total profit. Now we have to find out the price. So we will put this Q in the given demand equation. So if we will put what the demand equation is, first let it write down. Yeah. So now P equal to 1500 minus 0.01 into Q is 65,000. So P equal to 1500 minus 0.01 into 65,000. So 850 is the price. So now we can calculate the profit. First of all, revenue, and what is the quantity where profit is maximized? We have already calculated 65,000 and we do calculate the price 850. So we need the variable cost which is given the question, which is 200 into a quantity is 65,000. So we got a contribution. After that, less fixed cost. Fixed cost is 20 million. 1 2 3 4 5 6. So profit will be, okay, no, something I did mistake. No, it's right. Okay, so profit is 222 4 times 0. Okay, hope you got this. Okay, moving ahead. Question number is 115. What the question requirement is, which pricing policy gives the highest price? So first of all, prime cost one, option A. The prime cost is in the question given 12, and the company policy is to charge 80% margin or 80% markup. I think this will be because it is charging on the cost. So we will multiply it by, so price will be according to option A 21.6. For according to option B, the question told marginal cost. Marginal cost means all variable cost. So prime cost is variable plus variable overhead 3, and what is the percentage to be charged? 160. So it's 24. Okay. Now third option, total absorption cost. Total absorption cost means your all cost including the fixed one, variable plus fixed one. So 12 plus 3 plus 6, and what is the percentage to be charged on the price? 120, 20%, 25.2. Now last one, option D, but the question told 40 net margin of 40% on selling price. Okay, So first of all, we know only the cost which has been incurred in the manufacture the product, all cost, which is 12 plus 3 plus 6, right? uh, Now the question has told markup, and in the option A B C all are the, I'm sorry, in the option A B C the question has given the markup, but in only the option D the question has given the margin. So if margin has given, it means our cost will be 100 minus 14%, which is 86%. Okay, so our cost will be 86%, and we need to get value of 100%. So divide it by 86% and multiply it with by 100%. So this is what we got. Okay, so be careful with markup and margin. Markup is charge on the cost and margin is charge on the selling price. So if markup has given, our cost will be 100%. If margin has given, our selling price will be 100%. So now in the option D, margin has given 14%. It means our selling price is 100%. So if we will subtract margin from the selling price, we will get the cost. So 100% minus 14%. So it means 86% is the cost. So I have divided with 86% and multiply it by 100% in order to get a selling price. So out of all the option, which one will give the highest price? Option C. Okay. So next 16 number, what is the optimum price to be charged in order to maximize the profit? So again this is based on the 114 which we did earlier. So 116, what the question is, demand for the product is 5000 unit when price is 400, and 6000 unit when the price is 380, and variable cost of product is 200. So first of all, we have to formulate our demand equation, which is not given in the question. In the earlier question it was given. So first of all, demand equation is P is equal to A minus B into Q. So we don't know what the B is, what the Q is. I mean, we need to get calculated, right? B. So how do we calculate B? B equal to your change in price by change in quantity. What is the change in price? It's 20, but ignore the minus sign here. Okay, so change in price is 20, and what is the change in the quantity? 1000. So B is 0.02. So price has been decreased, so ignore the minus sign. Okay, now we have to calculate the A. So in order to calculate the A in the price equation, demand equation, I will keep B as we have calculated, and in the case of P and Q we will put the any of the value given. Like question has told demand for the product is 5000 when the price is 400, you can keep P as 400 and Q as a 5000, or you can keep the 6000 as a quantity and P as a 380. So whichever you feel in order to calculate the A. So I will keep first one. So P is 400 equal to A minus B is 0.02 into Q. So quantity is given in the questions. It's 6000, 5000. Okay, so 400 plus 0.02 into 5000, 500. So A equal to 500, A equal to 500. Fine. So now we got our price equation. P equal to A is 500 minus B is 0.02 into Q is, okay, Q will be as it is. Okay, so now question told to find out the optimum price. The question told to find out the optimum price. So again, in order to maximize the profit, so in order to maximize the profit, MR should be equal to MC. So MR equal to P minus 2, sorry, what I am writing, MR equal to A minus 2BQ. Okay, and MC is also given in the question, which is 200, right? So 200 equal to A is 500 minus 2 into B is 0.02 Q. So we can calculate the Q equal to 500 minus 200 divide by 0.04. So we got the Q 7500. So now we will put this value in the our original demand equation. So here is our demand equation. So P equal to 500 minus 0.02 into 7500. So P equal to 500 minus 0.02 into 7500. So 350. Okay, I hope this is clear. Okay, which three of the following pricing strategy could be used to price the game when it brand new game is about to launch? Okay, so question has told brand new game. So if the product is new or branded, and the question also told the game is unique, so you can charge this price skimming. Okay, and the can only be played on the star 2000 game console. Means while purchasing the game you have to purchase the console as well, because it will run, it will be played on the star gaming console. So another one of the business product. It means these are the complementary products. It means buying one you have to purchase other. So complementary product pricing, students are entitled to a small discount, so it means price discrimination. So these three are the strategy which could be used. Okay, so pehla first it's a brand and unique game, so in that case we will charge the price skimming, and it can only be play on the star 2000 gaming console. So it means while purchasing the game we have to purchase the console as well. So this is the complementary product pricing. Other students are entitled to small discount. Only student means discrimination arise, so price discrimination. 118. So what is the demand function? So this is same as we did, so I will say give a try to it. And 19 is also same as we did. So hope this lecture is benefited to you. So if you like, so do hit the like button and subscribe. Don't forget to subscribe my channel.